Hey everyone, welcome to the channel. Today, we're diving into one of the most critical topics in financial history, stock market crashes. These events are more than just numbers on a screen. They're seismic shifts that reshape economies, redefine regulations, and rewrite the playbook for investors like you and me. By the end of this video, you'll understand not just what caused these crashes, but why they matter today, and how you can safeguard your portfolio against future turbulence. Segment 1. The Panic of 1907, the crash that built modern finance. Our story started not in 1929, but earlier with the Panic of 1907. This crisis laid the groundwork for modern financial systems. In the early 1900s, the US lacked a central bank. Speculation ran rampant with trusts and unregulated banks overextending credit. The trigger? A failed cornering of United Copper Company. Stock collapsed the Knickerbocker Trust Company, the third largest trust in New York. So panic spread. Depositors rushed to withdraw funds, liquidity evaporated and stocks plummeted, and it entered JP Morgan, who personally orchestrated a bailout, pulling funds from banks and tycoons to stabilize the system. But why does this matter? The Panic of 1907 exposed systemic fragility. It led directly to the Federal Reserve creation in 1913, a lesson in the necessity of centralized liquidity. But as we'll see, even the Federal Reserve couldn't prevent the mother of all crashes. Segment 2. The Great Crash of 1929, the collapse that defined a century. October 24th, 1929, Black Thursday. The Dow Jones Industrial Average fell 11% at the open. By November, it had lost 48% of its value. But this wasn't just a crash, but the spark for the Great Depression. Let's dissect the causes. First, excessive leverage. Margin buying allowed investors to borrow up to 90% of stock prices. Overvaluation. The Dow's PE ratio had 32.6, higher than the dot-com bubble. And lastly, economic cracks. Agricultural decline, income inequality, and weak banks. When the bubble burst, margin calls triggered a fire sale. Panic became self-reinforcing, and by 1932, the Dow had fallen 89%. Unemployment hit 25% and thousands of banks failed. The aftermath? The Securities Act of 1933 and Glass-Steagall Act. Relegations to restore trust, but here's the critical takeaway. Crashes aren't just about markets, they're about human psychology, greed, fear, and herd mentality. Which brings us to 1987. Segment 3. Black Monday of 1987, the computer-driven crash. October 19th, 1987, Black Monday. The Dow dropped 22.6% in a single day, the most significant one-day percentage loss in history. But what caused it? It was a perfect storm of portfolio insurance, a hedging strategy that used algorithms to sell futures as markets fell. Overvaluation. The markets had rallied 44% in 1987 alone. And also the crashes in Hong Kong, London, and Australia spooked the US investors. But unlike 1929, the Fed acted swiftly. Alan Greenspan flooded the system with liquidity, and markets recovered within 2 years. The lesson? Technology amplifies volatility. Portfolio insurance, a tool meant to reduce risk, became a catalyst for disaster. Today, algorithmic trading and ETFs pose similar systemic risks. This raises the question, are we engineering the next crisis with our oils? Segment 4. The dot-com bubble of the 2000s. Irrational exuberance meets reality. By 1999, companies like Pets.com were valued at billions without even a profit. The Nasdaq soared 582% in 5 years, until March of 2000, when it collapsed 78% over 30 months. This was a crash driven by narrative over fundamentals. New economy, high-bled investors to ignore traditional metrics. Cisco traded a PE ratio of 200. Amazon hit $113 a share before crashing to 6. The fallout? $5 trillion in market value raised. However, unlike in 1929, the broader economy avoided depression thanks to Fed rate cuts and sector diversification. Segment 5. The 2008 Global Financial Crisis. Too big to fail. 2008 wasn't just a crash, it was a near-death experience for capitalism. The S&P 500 fell 57%, Lehman Brothers collapsed, and global GDP contracted by 0.1% in 2009, the first decline since World War II. So what was the root cause? Financialization. Subprime mortgages were packed into AAA-rated CDOs, insured by credit default swaps. When housing stalled, the $700 trillion derivatives market imploded. The Fed and Treasury responded with TARP bailouts, zero interest fees, and quantitative easing. Controversial? Absolutely. Necessary? Unquestionable. The key takeaway is complexity breeds fragility. When risk is hidden in an opaque instrument, the system becomes a house of cards. Segment 6. The 2020 COVID crash, the fastest bear market in history. From February 19th to March 23rd of 2020, within 33 days, that's all it took for the S&P 500 to drop 34%. The cause? A virus that brought global commerce to its knees. But, unlike prior crashes, this one had a silver lining. Unprecedented fiscal and monetary response. The Fed slashed rates to zero. Congress passed $2.2 trillion in stimulus, and retail investors flocked to platforms like Robinhood. By August of 2020, markets had fully recovered, a V-shaped rebound fueled by liquidity and speculation. The lesson here? Modern crashes are shorter but more volatile. Central banks have become the ultimate backstop, but at what cost? Inflation? Moral hazard? But that's another topic for another video. Segment 7. Lessons and strategies for the next crisis. Let's synthesize these patterns. So firstly, leverage kills. Every crash involves excessive debt, whether margin loans, mortgages, or corporate buybacks. And also narratives fuel bubbles. New areas in tech, housing, or money distract from fundamentals. And also lastly, regulations are cyclical. Post-crash reforms get watered down as memories fade. Some strategies I would suggest are stress testing portfolios for 30 to 50% drawdowns, diversifying across uncorrelated assets like commodities and volatility products, and cash reserves because the best opportunity arises when others are forced to sell. Remember, crashes aren't failures, they're resets. The investors who thrive are those who prepare. Stay liquid and lean into fear. If you take one thing from this video, let it be this. Market crashes are inevitable, but financial ruin is not. Understand history, respect risk, and never confuse a bull market for genius. For more deep dives into finance, smash that subscribe button and hit the bell. Until next time, stay prudent, curious, and keep compounding. Thank you.